Now this is the third video on cost, volume, profit. In the first video, we understood what a variable cost was and what a fixed cost. In the second one, we looked at a mixed cost and we broke the mixed cost into a fixed and variable. So now, looking at a company, we've taken all costs within the company and we've broken those costs into those costs that are variable, some are purely variable, and those that are fixed. And we've taken the mixed costs and we've broken them into fixed and variable. So in this video, we're concerned with number 4, the 5 components of the cost, volume, profit model, and we're going to introduce the contribution margin. To begin with, the cost, volume, profit is a model that helps us to study the effects of changes on both the cost and the volume of activity in a company and those effects on profit. This is very important for a manager. Important in profit planning because a manager is responsible or has some input into setting selling prices, determining what the product mix is, and so on. There are 5 components to the cost, volume, profit, and in this video we're going to deal just with the first 4. First of all, we must be aware of what we're talking about in terms of volume, the level of activity. And the second component is the selling price per unit of the product we're selling. And we now know what the variable cost for every unit we sell. So if we sell more units, the total variable costs will go up. And we understand what the fixed costs are involved in selling or producing more units. So these 4 elements are what we need. We need the selling price, we need the variable costs, we need the fixed costs, and we need the level of activity. Okay. We also make some assumptions, as we talked about in the first video, the relevant range and things of that nature. We assume that all costs are linear. That is, the variable costs go up like this, the fixed costs remain the same. We also assume that we can actually take every cost and break it into its complete variable portion and its fixed portion. Now, once we have all the costs in the company in terms of fixed and variable, we can rearrange the income statement. Now, we're not going to change the traditional income statement. The traditional income statement is sales less expenses, sales less expenses, and that gives me profit. Okay? The contribution margin, we are looking at sales minus variable costs. Now, variable costs, as sales increase, variable costs increase. So the difference between these two is called the contribution margin. For this Vargo video, here's an example. We sell the camcorders for $500. The variable costs are $300, the fixed costs are $200,000, and the units we sold are $1,600. Now we can produce a traditional income statement with sales minus all costs give me profit. Better to format it differently. Format the sales, 116 cameras for $800,000, minus the variable cost. That sales minus variable cost gives me what we call this contribution margin. Now this is not profit because we have not covered our fixed costs. It contributes to covering our fixed costs. And I have $320,000 in contribution margin. I only need $200 to cover my fixed costs. And once I pay my fixed costs, what I have left is my net income. Now we also look at the contribution margin on a unit basis. The contribution margin is available to cover my fixed costs. And whatever's left over after I cover my fixed costs is income. We look at it on a unit basis. Back to the example we had before. We said the unit selling price was $500. We said the variable cost is $300. So for every unit I sell, income's $500, but I have to pay $300 in variable costs to make that sale. I purchased the camcorder. So I have $200 left over. This $200 is the contribution margin for every unit I sell. Now, if I was to sell 1,000 units, this would be my income statement. And as you can see, sales 500, variable cost 300. Contribution margin is exactly equal to the fixed costs, so there is no net income. That means this is my break even, 1,000 camcorders. On a per unit basis, we can predict the break even as well, because on a per unit basis, we have the contribution margin per unit. And that is 200. And at 1,000 units, it would be exactly equal to the fixed cost. But the next unit I sell, 1,001 camcorders, you can see that my contribution margin goes up by that 200 in total. And I only need 200,000 to cover my fixed costs, so my profit. So you see, once I go beyond break even, that is, once I sell more than the number of camcorders I need to break even, which in this case is 1,000, for every one I sell above 1,000, my profit is going to go up by the contribution margin. Now that was the contribution margin on a per unit basis. We also calculate the contribution margin as a percentage of the selling price. And we call this the contribution margin ratio. Ratio is only a percentage. The contribution margin per unit in our example was 200. Recall 500 minus 3. All right, the selling price is 500. So I take the contribution margin as a percentage of that. That is 200 over 500, and I get 40%. This we call the contribution margin ratio. What would the effect be if I have an increase of one sale over my break even? Well, it would be 40% of the selling price. So 40% times 500, or my profit would be $200. So I could take the contribution margin ratio as a percentage of sales and subtract the fixed cost, and I would always have my net income. Here's another example. Assume current sales are $500,000, and it wants to know if I sell $100,000 more dollars in sales or 200 more units, what would be the effect? Well, here we have the income statement at the break even. Sales minus variable cost, contribution margin exactly equals fixed cost, so net income is 0. On a per unit basis, the contribution margin is 200. On a percentage basis, 200 as a percentage of 500 is 40%. Now, if I increase the sales from 500 to 600,000, notice my unit cost and percentages remain the same, but my total sales is 600. Well, my variable cost is always going to be 60% of sales. So my variable cost will go up to 360,000. My contribution margin, then when I subtract those two, also went up by 40,000. My fixed costs remain the same, so my profit would go up by 40,000 if I increase sales by 100%. Well, I could have done that very easily by taking the contribution margin ratio. Take the increase in sales, $100,000, times 0.40, and I would get the increase in profit. So the contribution margin ratio is very useful in predicting what will happen to profits when there are changes in sales activity. Now we look at the break-even model. The break-even model simply means that point where total revenues equal total costs. That's both fixed cost and variable costs. We can do it the mathematical way, and then we're going to move on to the contribution margin approach, and we'll show it in terms of graphs, and we'll do it two ways, both sales in units and sales in dollars. Now, to begin with, the break-even in mathematic ways. First of all, we say, okay, look, here's the result. Let Q be the number I need to sell to break even. So for every one I sell, I get $500. I have to pay $300 in variable costs, and I have total fixed costs of $200,000, and I want net income of 0. So when I subtract these two, I get 200Q. Notice that's my contribution margin, equals 200,000. When I divide it through, I get my break-even as being 1,000 units. Now, the break-even point and the contribution margin must equal total fixed costs. So the contribution margin technique, okay, Look, you've got the fixed cost of 200,000. You know your contribution margin, selling price is 500, variable cost is 300. So now we say contribution margin is 200. So the contribution margin per unit is 200. I divide one into the other and I get 1,000 units. So you see, I can get the break-even point in units by dividing through by the contribution margin per unit. Now, if I wanted to break even in dollars, well, I know the fixed cost is 40%, is 200,000, same thing. But the contribution margin ratio, recall, was 40%. So what's my break even in dollars? I divide the fixed cost by 40%, and I have to achieve total sales of $500,000, which is 1,000 camcorders at $500 each. So you see, I can determine the break-even by both methods. If I want the break-even in the number of units, I divide the fixed cost by the number of units, by the contribution margin per unit. If I want the break-even in the amount of total sales dollars, I divide the fixed cost by the contribution margin ratio.